Is disaster looming in the payroll report? Are banks really desperate to lend? And why is velocity getting crushed? Answer those questions and more on today's Macro Show. I'm your host, Steven Van Metre, and thanks for joining me today. Of course, you'd notice we've got a new spot of the kingdom we're hanging out today because this morning, after the ISM Services report came out, bonds got slammed, and people said, Steve, what's your response to that? Well, clearly the kingdom answered and drove bond prices back up. Of course, when you're fighting the Fed, a lot of people don't get that. They say, well, wait. I thought don't fight the Fed means buy stocks. Do you realize the Fed's buying bonds? Don't fight the Fed. It means buy bonds. So what's going on in this payroll report? Because Friday's non-farm payrolls is coming. And I have said on record that there is possibility that we will get a bad payroll report and it's going to turn the tides of the market, that they're finally going to start seeing what I see. And did we get a preview of that today? Well, we did, because ADP reports a couple days early, and they missed. They didn't miss by a little bit. They missed by a mile. Let's take a look at the ADP report, and it came in at 330,000 for July, and the market was expecting around 650,000, a huge report. And if you think about it, it makes sense. There should be a ton of jobs being created. What are we hearing in the services PMI that we're going to look at? Hey, we're hiring. I mean, you drive around town, you see signs all over the place, hiring. What do you hear employers complain about? Needing to hire. So what is the logical conclusion here? Is you think people would be going back to work, especially since the extended unemployment benefits are now about a month away from going away. Maybe people would look for work, and this is telling you that even if they are, they're not hiring, and it's staggering because this is a massive miss. Now, we look at were the jobs created? Well, small businesses hired, large businesses hired, but it was really the mid-sized businesses that hired the most. We already knew it wasn't going to be in the manufacturing sector. And how did we know that? Because the ISM manufacturing PMI told us that they weren't really hiring in the manufacturing sector. So this is no surprise. This number should be much larger. In fact, you look at the details, you see transportation sector was up, and you think that should be up a ton because we're hearing everywhere in the report that there aren't enough people to move goods and services to where they need to be. Instead, we saw education, something, and first in my family. My wife just recently signed a contract to go back to teaching, so she'll be in this number probably next month. And see leisure and hospitality up, business and professional services up, but you're not seeing it in the trade and transportation, which is where you'd really want to see this. Now look at total employment, and this is the graph that really tells you that, hey, we've got a problem, and it's a big one, because what are we expecting to see? As the economy is reopening, we're seeing businesses reopen, and what are they supposed to do? Hire, because there's supposed to be all of this demand. We keep hearing there's this massive amount of pent-up demand, and it's going to drive consumer spending, which is odd because, well, prior to the pandemic, there wasn't much demand, but now there's just so much demand, we're going to need people to fill it. And when you see this downward trend, it's not going in the right direction. So how does this bode for Friday's non-farm payroll report? Well, I overlaid the ADP report to the non-farm report. And as you can see, due to the outlying data set here, which I wish we could scrunch up in this graph, but we can't, it doesn't actually tell us a whole lot. So let's zoom in, and maybe we can see something. We've got to zoom in quite a bit to see that where ADP goes in red, so you see it's heading down, then heading up, heading down, the non-farm payroll report tends to follow, and there's big expectations on that, because what did we hear from a member of the FOMC recently? That he believed that if we see strong payroll numbers, that he's supporting a rate hike. And then today, not coincidentally, much later after those reports were released, that Fed's Kaplan said, quote, I will revisit my opinion from June. So in June, he said he thought a rate hike in 2022 would be reasonable. He said, I will revisit my opinion from June that a rate hike in 2022 would be reasonable And he meant at next month's FOMC meeting. So you already start to see that things in the economy are not going the way they should. And we had a preview. We talked about that on Monday with the ISM manufacturing report showing a slowdown. It's still growing, but the rate of that growth is slowing, indicating the economy is kind of peaking. Think of it as you're driving your car down the road, you're accelerating, you get to peak speed, and then you start slowing down. Probabilities mean that you're going to continue slowing down. At least that's tends to what we see in these surveys. So huge red flags there. Let's continue on with the rest of the show because we've got this post from Jamie Dimon that someone brought up on Twitter. Mike Bird did, and back in August 6, 2018, Jamie Dimon cautioned the 10-year Treasury yield could hit 5%. It's a higher probability than most people think. Well, that has not aged well at all. Way off base with the yields now. Looking around 1.2% on the 10-year. So Jamie Dimon, remember, he's the CEO of JP Morgan Base, completely got that one wrong. Let's head into the economic data. We've got producer prices out of Europe up 1.4%. So month over month in June, that's still a pretty strong number, bringing the year-over-year rate of change up to 10.2. That is really high. Move into the U.S. data. What do we see here? Factory orders up 1.5%. So we actually saw the factory orders, which are hard data, actually were higher than the soft survey data, which is a factory PMI, is suggesting that perhaps in the surveys, maybe their optimism is starting to wane a little bit. Durable goods, excluding defense, up 1.1% in June. Moving on, what do we have? Where is it? It's in here somewhere. The SLOOS data, I know it's in here. No, total vehicle sales. Well, anyways, the SLOOS data came out. Maybe they moved it, but what is that? That's a senior loan officer's opinion survey. Now, why does this matter? Now, it is a look back. You have to understand there's two things about this survey. It's a look back. So it tells you what senior loan officers were doing or thought about the banking industry in terms of, are they tightening financial conditions, easing them? And the second thing, and this is completely misrepresented all the time, is this is a diffusion index, meaning it's looking at the quarter over quarter change. It's not, you can't look at it as a picture and say, it's massively easing, because that is how people interpret it. They look at this chart here and they say, okay, net percentage of domestic response tightening standards for commercial industrial loans. Wow, they're so loose, they're looser than they've ever been since the 1990s. No, remember, this is a diffusion index. So this is now the second quarter that banks have eased lending conditions. It doesn't mean they're massively loose and they're handing money out to everybody. It just means they're not as tight as they were 2 quarters ago. So they are starting to ease. Now, will that last without all the stimulus? Well, I don't think it will, but we'll see. Let's continue looking at that. So we see that they eased commercial industrial loans. Did it create commercial industrial lending? Well, if you watch the Friday show, and if you don't, stay tuned to this Friday, we look at the lending data. And what are we seeing in the commercial industrial space? Well, we see loans are getting paid off and paid down, and there isn't lending growth there. So why are banks easing? See, these are questions you got to ask, is why is this happening? Why am I seeing this? Because the bank's loan books are shrinking. And how do you get people to borrow money? Well, you either lower rates, which the Fed's trying to do, or you ease conditions. And guess what? Neither of them are working the way the system needs it to. We need lending growth to show that this expansion is going to continue. Because if you don't get them, then financial conditions tighten, and you're starting to see the seeds of a recession being sowed. Let's continue on with this. Net percentage of domestic response reporting stronger demand for commercial industrial loans. This has been increasing. Again, diffusion index here. So they're seeing an increase in demand, but that demand is by far insufficient of what it needs to be. How about net percent of banks tightening standards for commercial real estate? Now, they're just starting to ease. Off very tight, great financial crisis level tight conditions. So just starting to ease a little bit on that. How about demand for commercial real estate loans? Well, that's up. So people are obviously looking to either refinance or get equity out of their commercial real estate. How about mortgage loans? Now you look at this again, and if you want to misinterpret these charts, you say, wow, it's as easy as it's ever been to get a loan for a house. And if anyone's gotten one or tried to, they know that that is absolutely untrue. What it means is we've gone from the second tightest. So you see it went tight, 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 and then tight, 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 tight down here. So potentially the second tightest financial conditions for real estate loans have eased slightly over the last 2 quarters. That's all it tells you. It's just eased a little bit. How about demand for mortgage loans? Well, that's up. Subprime is down. Maybe that's a good thing, but otherwise, demand for loans is increasing a little bit. And then what do we have down here? How about consumer loans? Net percent of domestic response, tightening standards for consumer loans. Well, we already know they were easing because we started to see credit card usage go up. We're seeing that standards for those loans have gone down now for 2 quarters. They're still rather tight. People have told me, hey, I find it a little easier to get credit, but not substantially easier. And that's the key. That's the way you understand this. And look at the banks who are willing to make those loans. Well, that's what they're looking to do, is get people to borrow money because, again, we're seeing this credit contraction, and that's dangerous for the economy. All right, let's head back to the economic data. Head over to Australia, go down under to the services PMI, and due to lockdowns there, you're seeing a further contraction in the services sector. Remember, on these PMIs, 50 is unchanged, below 50 is a contraction, above 50 is an expansion, so 44, definite contraction in the services sector in Australia. How about we then head north to China and to the cakes and services PMI, expanding at a bit faster rate, going from 50 unchanged to 54.9. So a little bit of good news from the Chinese services sector. And now let's head into Europe. Over to Italy, we've got the Italian services PMI expanding at a little bit faster rate than the month before. So that is good news for the service sector. How about we then go up over to France, expand at almost the same rate as the month before. So that's good news. In Germany, we see a services sector expanding at a bit faster rate. Also good news. And how about the broad Eurozone, which we should expect to see services PMI expand at just a bit faster rate. So overall, that's good. Now, is that something to get real excited about as we lead into the U.S. data? Not necessarily, because here's what I want you to understand. When there's demand in the economy, it starts to build up, right? What do people do? They go shopping. And as shelves are drained down, what do retailers do? Well, they call up the wholesalers. They need to order more stuff. And then the wholesalers see their shelves start to empty. And they go, wow, we need to get some more stuff. So they call up the manufacturer and say, hey, I'm putting in some new orders. And all of a sudden you see the manufacturing data start to move. And where does it go next? Then it flows down to the services sector. So you go from demand to manufacturing into services. So you always will see a lag, or at least you tend to see a lag in the manufacturing data. Usually a couple months later, you'll see the services sector peak. So that's why, even though the market briefly made a big issue out in bonds this morning after the ISM Services came out, which we'll look at, it's really not that big of a deal because it should be rising. That's what we should see in the data. And let's take a look if when we get down there in today's data. Let's go up to Great Britain first. Services PMI it expanded just a little bit slower rate than the month before. Overall, still a healthy number at 59.6. Mortgage applications down 1.7%. Refinance applications virtually flat. Now, car and truck sales were down, but this shouldn't be a surprise because everyone's saying the only reason they're down is because of lack of inventory. As soon as if inventory was there, these numbers would be busting off the charts. Here we see ADP Nonfarm Payroll. We talked about 330,000 jobs at market. I said 650, 695 is what the market expected. So that's setting up a downside surprise in the Friday Nonfarm Payroll report. We look at the market services PMI expanding at a bit, just a little slower rate than the month before. Still a healthy number of 59.9. And now let's get into the ISM. And to that, we'll go directly to the ISM website. And what do we see in July? Services PMI. I'm not sure if this is a record high or if but it's really close. 64.1. This number is way high, and that's exactly what we should see. And we should see it across the board. Business activity, production up, new orders up. These are all over last month. Employment up. But not that much. We went from 49.3 unchanged to 53.8. So it says they hired, but not a whole lot. Supplier delivery time. Well, we just saw there's not enough people to move stuff around. So that's up. Inventories unchanged. Prices paid up. Backlog of orders not up as much, but still a pretty strong number, 63.5. Export orders up. So this is, and import orders, it's just slightly unchanged, just a small expansion from the month before. So it just tells you that this all makes a lot of sense, that this is what we should indeed be seeing in the services sector. And that's not a good thing, because if the factory sector is peaking and rolling over and the services sector isn't creating jobs, what's going to happen when all of these people lose their extended unemployment benefits? They're not going to have the money to spend. And that is really the key point, that we're sitting kind of on the brink, and the brink is coming closer than experts thought. Even the Fed, you saw that with Kaplan. He said, look, I may have to change my mind, because this is not the way it's supposed to go. Let's continue on into the crude oil data. This is actually, the crude oil inventories were up 3.6 million. Oil went down, energy stocks went down, but we're still below our averages for this time. There's a range, and I think we're still under the 5-year numbers by a decent margin. So this isn't a big deal unless this number continues to rise, at multi-million-dollar barrels per week going forward. And then there's some cost of concern, but not much here, especially since we saw the gasoline inventories drop 5.3 million barrels. So that was a big decline there. And now let's talk about the velocity of money, because you may remember from my Macro Voices interview with Eric Townsend, phenomenal interview, and he really gave me a chance to go through and explain how the dollar prison works, how QE works. And one of the things I said is that the velocity of money, or how often money, either you can think of it as exchange hands or used in a transaction, I said it wasn't going to move much, maybe even go down. And what is everybody else said? Oh no, the economy is opening, money is going to be moving, the velocity of money is going to go way up, and that's going to validate inflation. All right, well, let's take a look at the chart, and whoa, it didn't go. In fact, it was virtually slightly down. So we'll just say unchanged in Q2. And many experts couldn't understand. They said, this doesn't make any sense. And I said, well, let me show you this chart, because when you understand what's going on in the banking system, and you understand how QE traps dollars in a prison, right? They can't get out. And you find out that most of those dollars are going primarily to 2 commercial banks, because one of them doesn't really take a lot of retail deposits, and another one is still in the penalty box thanks to the former the Janet Yellen-led Fed. You realize that money just can't move. And the way we look at that is to see the cash buildup in banks is really deflationary. And here you can see the cash assets at all commercial banks in red, shown inverted, as we did on the Macro Voices interview, and it's telling you that velocity stands virtually no chance of rising, and as cash continues to build up, will most likely head even lower. And so now this is a big case for lower interest rates and a weakening economy, because if velocity doesn't pick up and money can't move, well, then that means jobs aren't going to be there. Money needs to move. It needs to grease the wheels of the economy, and it's not. Now, as we wrap up, is there another warning sign that you should be paying attention to? And yes, it is. And it hasn't actually flagged a major doom move yet, but here you have the NASI, the NASDAQ McClellan Summation Index. And when it gets under the, around this minus 200 to minus 400 level, it threatens to go down. And when you see the summation index go down, well, I'll tell you what it also means is it means the equity market is going to head lower. And so this, if it's been saved, you see it got saved this time, maybe it'll get saved again. Stock prices will go back up. If we see further downward trend, and we'll keep you updated as we do the shows, that could send a risk-off move to the market. With that, thanks for watching. Thanks for being fans. Of course, I appreciate all the likes, all the subscribes. You are phenomenal. And as I always like to say, got to deal with that virtual green screen someday. If it wasn't for you, we wouldn't do this. And I look forward to seeing you back on Friday. Of course, we'll look at the banking data. We'll then validate, again, why banks, they're not desperate to lend. They just really need people to come out and borrow. People aren't borrowing near enough. Call it the curse of ZERP. Again, I'm your host, Steven Van Metre. Bye now. The content of this video provides educational information only, is not intended to provide investment or other advice. So as not to be construed as recognition or solicitation by selling security, financial instrument, or participating in particular trading strategies. This video was prepared by Steven Van Metre, personal capacity. Opinions expressed in this video that do not reflect the view of Atlas Financial Advising or Steven Van Metre Financial.